Yeah, it's a great pleasure to introduce Howard Lubert. Howard is co-founder and area president of Keiretsu Forum Mid-Atlantic. Keiretsu, as I'm sure Howard would give us some more background on it, but it's arguably the largest angel investing forum, certainly in the US, possibly in the world. In addition to his presidency of the East Coast of Keiretsu, back in 2020, Howard formed a fund, the AVP family of funds, which is a vehicle as a first-in investment, primarily into Keiretsu investments. Previously, Howard was instrumental and spent 5 years as managing director of the Rowan Innovation Fund. And I think it's probably fair to say, isn't it, Howard, that you've arguably negotiated more angel term sheets than anyone else on the sort of Eastern Seaboard. How many term sheets do you think you're up to these days, Howard?
I know I'm over 10,000.
There you go. So, in summary, there's not much that Howard hasn't seen and been through in the angel investing forum, and we appreciate his time and delighted to have him. He's without doubt one of the most experienced operators in the space, and we look forward to your pearls of wisdom, Howard, of how the right way to do this is. We'll be monitoring the chat, so if anyone has any questions, hopefully towards the end of Howard's talk, we can do some questions and answers. If people want to post questions in the chat, we can pick them up that way, either as we go along or towards the end, and we can do some questions at the end. But if we have time, depending how the timing goes, we'll do a quick networking event at the end. Otherwise, if we don't have time for that, I'll work with Zoe to make sure that all the participants, we get everyone's contact details. So if there's anyone on here that you want to connect with. But with that, Howard, I'll hand it over to you, and thanks for your time.
A word of wisdom from probably the most prolific investor in the history of investing. Kind of positions the world that we live in as angel investors, having to sit across the table from mostly wannabe entrepreneur. So let me quickly get you through as fast as I can. Quick self-serving introduction to Keiretsu. We are, in fact, the world's largest and most active angel investing network, with 33 chapters here in North America, another 23 in Europe, Asia, and Australia, for a total of 56 chapters. We are not only the world's largest and most active, but by tenfold in many cases, not dollars. Here's the 30-second elevator pitch for Keiretsu. And it helps position that. We have invested over $1 billion in our history. We typically invest, and you'll see from some slides in a minute, we typically invest around $90 million a year. Next most active angel group, which is Tech Coast Angels, invest typically between $25 and $30 million a year. So with the exception of some government-driven and funded organizations, we're 3 times larger than the next largest active angel group here in North America. Give you an idea of what we did here in the Mid-Atlantic and Southeast regions. Let me first call your attention to the graph on the right. So the chart on the right points out that in 2021, we received 356 unsolicited applications from companies that asked to present to us. We were able to cut that down to 121, which we invited to come in and screen with us. From that 121, we invited a total of 44 to come and present formally to our members during the course of 2021. We ended up funding 34 of those 44. We started due diligence on 30, we completed 22. And because we run an all-day investor capital expo every fall, where we invite at least 12 companies to present, we did end up seeing a total of 56 companies. We invested in 45 of them. On the left-hand chart, you can see how that money got spread out and how much we invested totally. And interestingly enough, for the first time in Keiretsu Forum Mid-Atlantic history, we actually wrote more checks in the tech silo, which of course is where Keiretsu Forum was founded in Silicon Valley in Northern California, than we did in the life sciences silo. But we did invest in one more life sciences company than in the tech silo. We just had some fantastic local deal flow in the tech silo. Here's how we look in 2021 from an investment status internationally. For the total investment of just under $89 million. And you can see how that breaks out on the pie chart. The HALO report came out about 3 months ago. The HALO report indicated a number of different things, the most important of which to us, of course, is that once again, we were ranked #1 by the most active based on deals. If it were based on dollars, I'm going to say this and it's going to sound facetious, so I apologize, but if it were based on dollars, no other angel group would have a shot. If it's based on the number of deals, it's a challenge for Keiretsu because we invest much later in the deal flow than most angel groups. Of the almost 285 angel groups in the Angel Capital Association, 80% of them invest in startups and very early seed or pre-seed money. We do not. We invest in much later deals. In the 11 years Keiretsu Forum Mid-Atlantic has been in existence, the smallest deal we've ever funded is $1.2 million. And I would suggest to you that 1.2 million is absolutely a seed deal in Silicon Valley. But here in Philadelphia, 1.2 million is probably qualifies as a Series A round. So you can see the breakdown of the 10 most active groups on the deal, and then the map on the right shows you how it is displaced. On the left is a chart that shows you how those dollars were invested deal-wise. Information technology and consumer products led the way for all of the angel groups that reported. Needless to say, those are spaces we invest in, but are not our key. And that little chart on the right shows you how Keiretsu Forum finished in all of the different regions that reported. With one unusual anomaly, New York is shown as we finished 4th, but the Mid-Atlantic region here owns and has as part of it New York. When you add the two together, we move back up. An interesting statistic on the chart on the left. The vast majority of angel investors invest in deals in their own region. So for example, looking at that top line, in California, 75.5% of all of the investments that were made by angels in California were in California-based deals. An anomaly took place for the first time in the history of HALO tracking on the right-hand chart. For the first time in the history of them taking these numbers, when angels invest outside of their home region until 2021, the vast majority of those excess investments took place in California. And for the last year, for the very first time, the majority of deals took place in the Southeast region. And my 2 chapters in the Southeast region in Atlanta and Southern Florida can attest to the increase in activity that we've had there. From the Angel Capital Association's 2020 Angel Funders Report, unfortunately, they don't release their information until their annual summit meeting, which takes place in May. So in May of this year, they released the numbers for 2020, and they have not yet shared 2021. But there's a good grasp here of what you might think of looking at. So typical angel group invests $4.7 million a year, call it $5 million. The vast majority of that, as I've already pointed out, in very early stage deals and startups. It's not unusual for an angel group to write a check for $25,000. For us, again, as I pointed out, our investors write checks for $25,000, but when those are all combined, we're typically funding multi-million-dollar rounds. So it's interesting to see the important piece of this is that year over year, the amount of investment from angel groups, even the smallest ones, continues to go up, and so does the average number of deals. as well as the average investment. Unfortunately, in any space, whether it's angel or VC, I spent many years at Safeguard Scientifics before leaving to start my own business and then take over Keiretsu. When you tell an entrepreneur that you funded 34 companies by 13 point some million dollars, they take out the calculator and divide 13 point something by 34 and say, so you average invest $450,000 in the deal. And the answer couldn't be farther from the truth. We've had deals in 2021. We had deals where we put $3 million. And because of the syndication, we might have put $13 million. So average investment numbers are always misleading, but at least it gives you an idea of where the entire space fits. So as promised in the title of the group, let's take a look at angel investing as an asset class. First and foremost, allow me to point out what the ladder looks like from a company that's a raw startup all the way through perhaps an exit or an IPO. It lays out like this. Those three burgundy arrows that just happen to match the color of Keiretsu fall in those three categories there in the middle. And if you take nothing else from this class, from this presentation today, then this one slide, this is the key to the kingdom. And if you notice in the upper right-hand corner, there's a gold key there. You will see that on just a handful of slides in the deck. That's there obviously to represent a key takeaway in today's presentation. So hopefully you've had an opportunity to read that. 2.5x return is not shoddy in any space. However, to get there, you've got to build and manage a very diversified portfolio, as this slide points out. And hopefully you would agree with the logic at the very bottom where it says why. Because the universe of investments does not exist in any one silo, and it certainly doesn't exist in any one region. And the last, I hope, again, by apologies, since I'm obviously here representing Keiretsu Forum today, this is obviously going to be Keiretsu Forum slanted on slides, and you're all intelligent people, you'll make your own decisions. Needless to say, with 33 chapters in North America, all doing the same thing with the same rigor, the odds of getting the opportunity to see the most diverse portfolio exists in a group like that. But this is the key to the kingdom. Here is the asset class slide, and there are two of these. Why? Because there have been two totally separate studies that were done. They both prove the same thing. The world's highest returning asset class is the early stage VC index on this slide. And it's the reporting angel group's return that got us to that 27.2% IRR on this slide. Now, needless to say, with reward comes what? Risk. So the earlier you invest in a company, the greater risk you are going to accept. We, as I've already said, we are not very early stage investors. We're early stage, but we are not the guys that write the $25,000 checks for startups. We are not the people that do pre-seed. We are typically the guys who come along when a company is ready to transition from R&D to sales and market. And that's our key inflection point. The exception, of course, being life science companies because of the typical long tail. But those are the two keys to the kingdom. The research has been done. The research proves if you're willing to take the risk, the returns are going to be astronomical by comparison to the other asset classes. And a study that was done by MIT and Harvard, the research came away which was pretty surprising to them, not to me, that angels outperformed VCs. Why? We're investing our own money. I would like to suggest to you that we're a lot more attentive to writing our own checks than when the VCs are writing. And I've been a VC for a long, long time. So when we wrote checks at Safeguard, when I write checks in our fund, it is, I hope, with a level of rigor, but it doesn't match the same as when each individual writes their own check in a deal. So what does it take to become a successful investor? Any questions so far? Good. Allow me to point out that it's a lot of work. And if you're going to be successful, you need to protect your upside. I would point out to you, with one exception, it is absolutely impossible for an independent angel investor to do what any group of angels does, because they just don't have the expertise, the ability, the time, or the diligence to be able to vet enough different deals to build the kind of portfolio we talked about. But there's a huge exception. Assume for a moment that you are a subject matter expert in a business and you've just sold that business for $100 million, and you decide to become an angel investor. And you obviously happen to have an area of expertise that's second perhaps to none in the space of that successful business that you built. If you were to find an investment opportunity in a related or the same space, there is absolutely no question that you are likely to be able to invest the time and effort, and obviously the dollars, to invest in a company where you are a subject matter expert and potentially be very successful. Assuming, of course, you're willing to invest the amount of time and effort to work with that company to bring it along, similar to what you did to build the company that you exited from. So again, just to highlight the challenges of individual angel investors, there's a lack of consistent deal flow. Needless to say that an individual probably could not have gotten through 356 applications in a year. Squirreled that down to 121 individual screening meetings to get to 44 potential investments, and then on top of that, picking which of the 44 would you individually invest in. You probably don't have the individual investor probably does not have a lot of due diligence expertise, something that Keiretsu is famous for. We're famous for two things: being the biggest and most active, and the fact that we have the most rigorous due diligence process on the planet, which leads us, we believe, to the most successful portfolio building tools out there. An individual investor, again, the exception aside, the individual investor is not likely going to write a big enough check in a deal to be able to control the deal. We control 70% of the deals we do in the Mid-Atlantic and Southeast region. And when I say we control them, we do the due diligence and we dictate the term sheet. That's about similar to what we did at Safeguard when I was there. So similar to being able to have total control, leading the deal, and making sure that our members are investing in the best possible deals with the best possible terms is something that individual investors just don't get. And then, of course, once the investment's in, how much time can you afford to invest? And I'm going to share some time numbers with you that I just recently got through for a presentation I'll be doing at a university in November. But allow me to point out that Pareto's law, most of you probably know that as the 80-20 rule, but Pareto's law is alive and well in angel investing. Just go back and do the math on the numbers I'll share it with you. For every 10 deals that we see, 8 are just not going to cut it. 2 are going to be partially successful or very successful, but I'm going to assume that none of them are going to hit it out of the park successful. None of them are unicorns. So how do you know which 2 to pick? The answer, of course, is angel investing groups or getting together as a group. And needless to say, here in the Philadelphia area, there is no shortage of angel groups you should be looking at. If you happen to be interested in very early stage deals and startups, you might want to consider Broad Street Angels. You might want to consider a number of the other groups. The group with the longest history in Philadelphia, of course, is Robin Hood Ventures. They invest in earlier deals than Keiretsu, as well as deals at our level. And we co-invest with them on a regular basis. But the advantage of coming together, as you can see from the 4 bullets on this, are the fact that you end up de-risking the deal as much as you possibly can. In the 11-year history of Keiretsu and the hundreds of due diligence reports we've done since I started here on the East Coast, we have never once not been able to source a due diligence subject matter expert from Keiretsu members here in North America. And when it comes to life sciences, whether it's pharma or medical devices or biotech, we've never had to go outside of our region. Needless to say, the Mid-Atlantic region leads the life sciences silo for the rest of the United States. So how do we address that? And when I say we, again, this is a Keiretsu focused slide, but think of it as any angel group. So we are, however, the only angel group in Philadelphia that has a professional management team. This is what I do full time. This is what I've been doing for 11 years. And as I say, knock on wood, thank God, I made some phenomenal investments early on and back in my Safeguard days. And when Keiretsu Forum came along and I had an opportunity to start it, I was in a position to step in and do this full time without having to worry about getting a paycheck every day. Knock on wood, my wife, who was in GF management for 31 years, for those of you that have never heard of GF, the bellwether for us is Barb was the chairperson of Valley Forge Casino and Resorts, which was one of GF's major properties. When we sold that property to Boyd Gaming, my wife's retirement window just went through the roof, and we were able to step away. And my wife has now been retired for about a year and a half. So professional team management is always key. Obviously, we have a process that works, which I'll explain to you in a little bit. We have a standardized due diligence process which has been adopted by more than 3 dozen other angel groups who also happen to be a member of the ACA. We've put our due diligence process in the public domain. And then again, when you come together and you have the clout to be able to step up and lead a deal by writing the due diligence in the term sheet, you obviously have total control over the numbers that investors are ready to look at. Give you kind of an idea. I know I already mentioned that the smallest deal we've ever done is 1.2 million. Allow me to share with you the Keiretsu Forum Mid-Atlantic growth deals last year. We are in the process of doing a Series B with a tech company. We're leading a $20 million round. Last year or the year before last, Orion Pharma, we're leading a $15 million round. So we've done deals across the board where there are no VCs to step in and help make that happen. I'm going to go through these next slides very quick because again, you have them. This is the first of 3 funnels that describes the Keiretsu process. From the day we get an application until the day on this slide when a company successfully presents to our members and generates enough interest on what we call the gold sheet that we invite them into due diligence. When a company screens with us, this is the actual form that we use to rank the companies that come in. Ironically, we screen because of the Jewish holiday. We moved our screening meeting, which is always on the first Wednesday of the month, to this past Tuesday. We screened the 9 companies, and you can kind of take a quick look at that and get an idea of what it is we're looking for in those companies. And by the way, we invite all of the companies to attend the entire meeting, which typically runs 3 to 3.5 hours, because they then get to listen to the kinds of questions our screening committee members ask, and they also get to hear the kind of feedback that they get as a result of their presentations. Unlike some groups, when we invite a company to come in the screen, we do not coach them in any way ahead of that, so that we see some pretty raw presentations. That's intentional. No company that gets invited to present to our members formally in our monthly meetings is allowed to attend until they have successfully completed at least one coaching session with our coaches. So once they move into due diligence, you'll notice the funnel is about the same length, but it's gotten narrower. We put a team together and move forward. Our goal is to complete due diligence in no more than 6 to 8 weeks once the team is together. And then once a company graduates and actually has a due diligence report, we are there for a very, very typically long and narrow final piece of the puzzle. We take board seats, we become advisors, we have significant hands-on support, and so on and so forth. as I tell people, we are womb to tomb investors. From the day we get the application until the liquidity event, we want to be involved with the company to help them succeed. And we try to position everything we do as a significant partner, not an adversary, as you'll see in some of the later slides. So let me tell you a little bit about time. We've done a lot of research on time. The slide that you're looking at here is what we share with entrepreneurs who come to us and say, how long is it going to take us to get funded? And the answer to that, of course, is that exact information is unknown. What is known is how much time you're going to have to invest to get funded. And it breaks down kind of like you see here. And these are obviously rough averages, but they still work. From the time you go out, hopefully, and you research 6 possible hot leads that are in your space that you would like to bring on until the time you actually get the funding. And you see how that breaks down. It then goes on to doing the formal presentations. You'll notice it says 6 to 48 hours. That's an anomaly only because sometimes you have to get on an airplane and fly to the group and present live. For those of you that can remember pre-COVID days, when all Keiretsu had was live meetings, except our Wednesday meeting out of Philadelphia was always broadcast on Zoom. We've been on Zoom over 10 years for those members who couldn't make their own meeting. So you've got to allow that travel time and so on and so forth in the window. And by the way, if you were invited to present to the Mid-Atlantic region, you would present to 4 chapters over 4 days. Now 5 chapters over 4 days. 6 to 8 weeks of intense work effort and due diligence, as you can see. So if you drop down to the bottom line, the typical entrepreneur and their team are likely to invest over 200 hours in preparing to get funding. And if you ask what the time money formula for that is, it works out to about $2,500 to $5,000 per hour invested, based on $1 million raise. How about investor time? This is probably going to shock most of you. So we invite companies into screening. We look at, again, that's a 4-hour meeting. We've done pre-due diligence on those companies. They come in, we then put a due diligence team together. It's typically 4 to 8 members times 20 hours each equals somewhere between 80 and 160 hours. We also have a very active due diligence fellows program with Penn Law, Drexel Law, Drexel Business, Temple, and so on. Also Columbia up in New York, Columbia University on the medical school sides, and we're expanding that into the Southeast as we go. It could take us 2 to 10 hours to negotiate the term sheet, and so on and so on. So when all is said and done, as a group, we typically invest an average of 171 hours before we write a check. So what's the solution to becoming a successful angel investor? First, adopt and follow a tried and true model. And although no key on this slide, that following line, we bet on jockeys, not horses, is also a key takeaway. Why is that? So here's a look at the model that I developed when I was hired and joined Safeguard Scientifics. When Pete Musser asked me to come in, the very first thing I did was validate the Safeguard and document the Safeguard investment model. It may not come as a surprise to any of you, but allow me to share that I've sat in on many meetings in the boardroom at Safeguard where a company stood up and presented, and Pete Musser would look at the CEO and point his finger at him and say, you know, I like you. We're going to invest in your deal. And 10 other vice presidents sitting around the table, you could hear simultaneously 10 thuds as the 10 heads hit the table. Here was Pete making a commitment to invest in a company, and there hadn't been 1 minute of due diligence done yet. One of the things that I was able to do was help validate a model, but I won't lie to you and tell you fixed the Pete early comment problem, but it did standardize the process much better. And it's obviously what I took out of Safeguard and brought to Keiretsu. The important part of this model, and there are a lot of detailed slides go after this, which I'm not going to bore you with. The important part of this model is it's about mitigating risk in order of priority: people, plan, technology, marketplace. First and foremost, we bet on jockeys. People, then the plan, then the technology, then the market. So if you're doing all of that, you are obviously creating a very robust and rigorous due diligence. This is kind of a summary slide that kind of looks like the suggestion that that rigorous due diligence leads and gives you that same. By the way, again, going to sound egotistical, I apologize. I am a psychologist by education, and that's what I brought to Safeguard when I went there in building this model. This model has never failed. So as I say to people when they look at this for the first time, the reason there's a three-legged stool there is the three legs of the stool have to be the same, don't have to be the same length, and they don't have to be the same girth. But each leg has to be strong enough to hold the stool up. And the only way they can do that, of course, is if they're attached at the top by a seat. People, plan, technology, market. So the only leg of the stool that must be as strong as possible is the people stool. We invest in jockeys, not horses. So as part of the solution, there's also this thing called commitment. And I love the analogy of the pig and the hen to the ham and egg breakfast. The hen's involved, the pig's committed. Now, just so we're clear, I don't expect entrepreneurs to gut themselves so that they can serve themselves up on the plate. I will share with you a story. When I was a rookie in IBM, I went to training in Atlanta. And one day on the weekend, just to get away from all the work we were doing, I was driving down the road to find a farm where somebody had told me about where I could buy some red delicious apples. And as I was driving up the road, I saw somebody walking on the side of the road that looked like he had a dog with him. As I got closer, I realized that it was a guy walking a pig. And as I went by, I saw that the pig had a wooden leg. So I slammed on the brakes and pulled over, and I jumped out of the car and I walked back to the guy and I said, "Sir, you're a pig." And before I could say anything else, he said, "Son, this here is a special pig. My wife picked this piglet, my daughter, picked this piglet and raised it from the day it was born." I said, "But sir, he's got a wooden leg." And he said, "Son, one night our house caught on fire and our pig woke up, got my daughter up and came and got my wife and I up and saved our lives, got us out of the house before it burned down." And I said, "But sir, wooden leg." And he said, "Son, this here's a special pig. You don't eat him all at once." See if you smart. Okay. So commitment obviously is a matter of judgment. So you also need to manage some expectations. Again, from the investor side, here's the kinds of situation you're looking at. Peretzi Forum North America will see over 2,000 company applications this year, and we will end up funding probably just over 200, 10%. Here in the Mid-Atlantic Southeast, we will see somewhere between 375 and 400. We will again narrow those down to just 44 presenting companies. And based on our history, we will fund 75 to 80% of it. As a group, we'll invest 90 million plus or minus dollars. And here in the Mid-Atlantic and Southeast, we have averaged 15% of that since we started doing this on the East Coast. Needless to say, there's no shortage of exceptional deal flow and no shortage of experienced people ready to come pitch to us to get our money. From the investor side, we also expect when we're sitting across the table from a company, we expect the same level of respect for the expertise we bring to the table that they do, and I'll share their side in a minute. We hope there's respect for the track record. We hope they understand because we hit them up the side of the head with this right from the beginning. We are looking to establish long-term partnerships with each and every one of our portfolio companies. We are not VCs. We do not write a check and then check up on them every 6 months. We put members on their boards. We put advisors in. Typically, we have subject matter experts who volunteer and step up to help grow the company, and so on and so forth. And we expect a willingness to negotiate with us as a partner, not an adversary, because that's the position we take. We're not looking to steal the company. If you think back to the old days of VCs, I can remember in Philadelphia, like it was yesterday, that the typical deal was, we're going to fund your company, but we want 51%, take it or leave it. I'll bet I sat in rooms that had that statement made 100 times, maybe 200 times. That's the nature of the VC, or that was the nature of the VC space. It has fortunately changed a lot. We are not looking to dictate rates, but we are looking to manage the investment deal. From the entrepreneur side, what are you going to do to differentiate against everything else that's out there to get our attention? Again, how committed are you? We respect the expertise you bring to the table. As I say often, you've forgotten more about the secret sauce that you built into this business than we could ever assimilate. Please give us the same credit. I've been doing this 36 years. I've forgotten more about how to put a term sheet together than virtually any other person you'll ever meet. And by the way, with some rare exceptions, including one of the people on the call today, I probably know more about term sheets than your attorney. And again, understanding and accepting that the deal is negotiated together, but the format of the deal is controlled by the investors. We use a participating preferred term sheet, which is a very aggressive but fair term sheet, and virtually every term in the term sheet is subject to negotiation with the company, just not the format. And by the way, that format is one you should all be thinking about. That format says that upon a liquidity event or upon distributions of profits, the investors get 70% of the distributions first until such time as they've gotten 100% of their investment back. Or if it's a liquidity event, let me, by example, say this. So a company got sold for $100 million and we invested $10 million. And we own 25% of the company for our $10 million investment. The company gets the check for $100 million. The first thing that happens is $10 million, assuming there had been no distributions. The first thing that happens is we get 1x back. So we take $10 million off the top, which leaves $90 million. And then we get 25% of the 90, and the founders, the common holders, and everyone that came before us get 75% of the 90. So if you invest through a participating preferred term sheet, you are guaranteed a 1x return. Assuming the company is successful, you are guaranteed a 1x return to get your money back for the risk you initially took, and then you participate pro rata with everyone in the deal for your percentage of ownership in the company. And by the way, if I've heard it once, I've heard it 1,000 times from attorneys from entrepreneurial groups that say something like, participating preferred is not the common format that is used in deals today. And my answer, of course, is it is with Keiretsu. And when he says, well, why is that? I said, there's one very simple reason. And believe it or not, it's not greed. Simple reason is this: a participating preferred term sheet, when structured correctly, excites and attracts investors and gets them to write checks. Because believe it or not, the first mantra of Keiretsu is to get the deal funded. And that's what the term sheet does. Kind of a strange final thought to leave you with, but again, I've been putting something together for university entrepreneurs, and I thought I would share this with you. The most successful exits that we have been with guys who or gals who may have been serial entrepreneurs, but are no longer trying to build and run company after company after company. In fact, one of our most successful is now running a venture fund in Texas. And I work with him all the time. And he's famous in the angel investment space because he raised over $52 million from just over 400 angel investors over a period of 4.5 years in 3 rounds in the pharma space. He never spoke to a VC because he never had to. And Keiretsu members invested just over 22 of the 52 million, not quite half. But active group, active thing. The last look at the link here for download materials, and here are the 4 items that you will find there. Some of them are fairly large files, but they're all PDFs. You should be able to download them without any trouble. And I'm ready to take any final questions. Andy.
Howard, thanks very much for that. That was very informative. So yeah, I just wanted to, I mean, you mentioned that angel investing is, is a numbers game. So without doubt, over the years, you've had some investments that haven't gone according to plan, and I'm guessing you've lost money on. So, I mean, can you talk about some of the lessons that you've learned from the ones that have gone wrong as opposed to the ones that have gone right?
Well, sure, happy to. So allow me to preface what I'm about to say by a statistic. As I said earlier, I didn't start Keiretsu because I needed to build a new channel for a paycheck. Keiretsu in Mid-Atlantic and Southeast have been doing incredibly well during the pandemic, if for no other reason, because most of our members have had more time to invest in the deals. But that said, I have been blessed in that the deals that I've made early on, most of which, by the way, were follow-ons to Safeguard, or thank God, my wife's investments in some of the real estate we did, along with the real estate and other deals that I've done. Most of you probably know that my brother Ira is likely the largest and most successful VC in the history of venture here in the greater Philadelphia area, probably managing somewhere just north of $25 billion, almost all institutional money. So in retrospect, deals are always obvious to you. Obviously, in hindsight, everything works out. But on the front end, I can tell you that my single greatest loss is I lost $1 million. The deal that I co-did with Pete and Safeguard, and it was a technology deal. And when the deal failed, it was for 2 reasons. If you build it, they don't necessarily come, and the management team was flawed. And the excitement that this team was able to generate and get Pete personally involved, where Pete personally invested a lot of money, and he attracted a lot of followers to the Pete Musser clan that invested a lot of money. And I was asked to take a look at this deal and vet the technology, and I did. And the technology was unbelievably incredible. This was a group of guys that invented a technology that made the internet work faster without changing bandwidth. It was just amazing technology. The problem is no one wanted to buy it. And we discovered, obviously, as we discovered that challenge, we also discovered that the management team was flawed. In other deals, when you invest in a pharma deal, you probably need to understand that the likelihood of that deal being successful is probably less than 10%, let alone less than perhaps 5%. That's just the way pharma is. The number of deals that get all the way through phase 3 clinicals and out on the street is so incredibly low percentage-wise. However, every one that does is billions and billions of dollars. That's why we take the risk. In the medical device space, the risk is probably much better, 25%. In the other deals that we invest in, obviously, it's a silo by silo thing. If I had to think back of some of the other deals that we've invested in, I would say that probably the number one reason a deal fails is that the company underestimates what it really needs to get the milestones done to get to profitability, and they don't have enough money. And they come back at a point where it's so drastic and so short-lived that investors don't have their time and can't make the time to get their arms around it to discover if it's worth writing another check. And therefore the majority just walk away. And then, when I was at Safeguard, I would tell you that the batting average at Safeguard was 333. If you're in Major League Baseball and you bat 333, you are obviously an all-star and you're a multi-million-dollar player on a team. If a venture fund bats 333 in the old days, they were doing phenomenally well. Today, 333 doesn't cut it. In the angel space, 333 is probably close to what happens. 3 out of 10 to 2 out of 10 at 20%, et cetera, are probably the ones that generate all the money back. At Keiretsu, the number's much higher. But again, it's higher percentage-wise because we spend so much time in due diligence, so much time vetting the deals, but that doesn't make them perfect for obvious reasons. Hopefully that answered the question.
Yeah,
Long
no,
way. Sorry.
thanks, Aaron.
Anyone else?
Just another one from me.
This must be the most intelligent group I've ever had a chance to present to you. Can I sign you all up as Keiretsu members?
Well, that was actually going to be my next question. If, I'm sure a lot of your members don't necessarily have an investment background. They maybe come out of, completely unconnected industries. So if someone's interested in being in angel investing, I mean, how do, as part of Keiretsu or another group, how would they sort of educate themselves? So, I mean, I understand you've got the sort of group environment, which obviously helps that, but, people obviously want to individually educate themselves as well.
Yeah. Again, I think I've been pretty astute in the documents that I placed in the folder for you to download. I think the second item there, our guest guide and orientation handout, is a 12-page PDF that I think will give you a phenomenal overview of how Keiretsu works. And needless to say, I'm biased, but needless to say, I believe, and the industry believes, that Keiretsu, being the most active and the largest, is probably the best. That's a huge misnomer. It may not be the best for any one of you, because for it to be the best, it not only has to show you the kinds of investment opportunities you're interested in, but like the group you're in now, it has to generate a collegial environment that you're going to be very interested in participating in. And I obviously can't. I mean, Andy and Fred Wilf have been involved with us for many years. They know what the Keiretsu environment's like. So to answer the question as simply as I can, go through the guest guide and orientation. Then do some homework and look at other angel groups wherever you may be located. If you're in Philadelphia, you certainly should look at Robinhood. You certainly should look at Broad Street Angels. They're two of the more active groups in the area. You ought to look at MABA, and there are just a couple others. And then you should decide how much time and effort you want to invest in this. And by the way, there's two kinds of investors, active and passive. If you want to be a passive investor, you should call my brother and ask him if he's got any fund open that you can hand a check over to him. And when you do that, just like Harvard, Yale, Princeton, Pacers, et cetera, all they want to know is how much of a return did I get this quarter. They don't get to have any say in the way Lieber Dadler invests its money. If you want to be an active investor, we are likely the most active group around, followed by Broad Street and so on and so forth. And you want to be willing to make an investment in time and effort, as well as writing a check to get in the group so that you can find the best possible deals. I think one of the ways you should do that is you should ask for an invitation to attend one of the angel group's meetings. We will have the October meeting of Keiretsu Forum Mid-Atlantic on October 19th. If any of you would be interested in attending as Andy's guest, just let him know, and he will get you registered for that event. We are still 100% Zoom. Coming out of Zoom in November, when we will run an all-day Investor Capital Expo, which will have 12 companies presenting instead of 4. So if you'd like to attend our October meeting, you should do that. You should attend as a guest at any other angel group you're considering. You should speak to some of the members of the group and ask them, why did they join and has it been worthwhile? And so on and so forth. And don't take Howard's word for it just because Howard happened to be the co-founder of the Mid-Atlantic and now the Southeast region. Obviously, I drank the Kool-Aid. When I discovered Keiretsu Forum 12 years ago while I was attending a conference in San Diego, I listened to somebody explaining the Keiretsu model to a group of entrepreneurs, and I shook my head. And I said, "There's nothing like this in Philadelphia." So that night, back in my hotel room, I went online and I looked at the Keiretsu website. I'd never heard of them. I looked at it. I was impressed. I wrote an email to the founder, Randy Williams, who ironically never replied back. But 6 months later, I was at a second conference in California, and there was a different person there talking about Keiretsu to someone, and I tapped him on the shoulder and told him the story I just shared with you. He immediately got up from the table, said, "Don't leave." He walked away and he came back with another guy who happened to be a sponsor of the original chapter of Keiretsu. And I, for the third time, told that story. And he personally introduced me to Randy. The following week, I flew out to California and I played a round of golf with Randy Williams, the founder. And at the end of that round of golf, Randy said, "You're the right guy. You can have the Philadelphia if you want it." It turned out there was a second person interested, and I insisted on meeting him. And by the way, allow the psychologist in me to point something out that'll probably also make you smile. And that is, I believe that I can learn more about a person in 4 hours on a golf course than I might in 4 months working with them in a business. Your personality just cannot hide when you're out there struggling to play the world's most difficult game. But anyway, so that's kind of how it all came about. Do your homework, pick the best one. Allow me to point out that if you were interested in Keiretsu and you joined by the time we open the November Investor Capital Expo, there are some significant discounts available for your first year's membership, as Mindy will share with you. And then after that, it costs a whopping $3,000 a year normally to be a member of Keiretsu. $3,000, all of which is tax deductible. Because once you join a group like Keiretsu, you're a professional investor. You get to write your expenses off.
And Howard, I mean, if someone, again, is considering getting into angel investing, we're certainly not suggesting they sort of remortgage their house and put it all into angel investing. I mean, it makes sense to be part of a sort of wider portfolio. But in your mind, if someone wants to start off and obviously build a portfolio, is there a minimum amount of capital that they need to be thinking about sort of attributing to it?
Yeah, that's a great question. So the research that's been done on angel investing tells you this. The typical investment in a deal by an individual investor is $25,000. The Angel Capital Association tracks that very carefully, and it's been $25,000 for the last 9 years. That said, I can share with you that the typical Keiretsu member is probably investing between $50,000 and $100,000 a year, not including the super angels that we have. We have a number of members. In fact, we have a total of 17 members who have written $1 million checks in individual deals. So they're out there. But when you factor those out, the typical member here on the East Coast is investing between $50,000 and $100,000 a year. The typical Keiretsu member in Northern California and the Pacific Northwest is investing between $100,000 and $250,000 a year. It's a different demographic. The members out West are typically very, very wealthy, retired individuals who are using Keiretsu partly as a way to stay intellectually sharp and entertained. And they are literally investing what I refer to as play money. They have already taken care of their family. Their retirements are all secured. They've taken some of that money and it's play money, and they're having fun doing it. Here on the East Coast, the vast majority of our members are people probably like you. You own or are partners in businesses. You're actively working in a business, but you have some excess capital, and you're also looking for some ways to maximize that. And if you have the time, then angel investing obviously is the way to get active in the space to do it. because again, it's the best asset class to invest in. So one of the things we do, if you remember the slide, it said you have to build a portfolio of 20 fully vetted and disparate investments to guarantee a successful return of it's no guarantee, but it's an 80% chance that you will have at least a 2.5x return. So one of the things groups like Keiretsu do, and we're very active in, is we create SPVs, special purpose vehicles. We will create an investment vehicle for our members so that they can invest as little as $10,000 in the deal. As long as there's at least 5 Keiretsu members who want to invest in the deal, we will pool $50,000 or more dollars together and write one single check in the deal on behalf of our members. And we structure an SPV so that, again, think this way. You're a member willing to invest $100,000 a year, you haven't made any investments. If the average investment's 25 grand, it's going to take you 5 years to build your portfolio. If that's okay, that's a great model. If you want to get that model built faster and you're still willing to invest $100,000 a year, you could hypothetically get into up to 10 SPVs at $10,000 a piece and have your 20 vetted companies in your pocket at the end of your second year. Now, you're investing 40% of the minimum ask of the deal. So your return is going to be 40% of the return on investment. So if you'd have written a check for $25,000, you're going to obviously get back much, much more than if you wrote a check for 10. But it's a way to get started. And any group you join, the other caveat, any group you look at, they must have some active educational investor academy like we do. We teach you how to do due diligence. We teach you what term sheets are like. We teach you how to read a cap table and understand it. We teach you how to help negotiate valuation. And then we invite you to participate as part of due diligence teams to do that. So wherever you go, however you invest. By the way, just as an aside, Andy pointed out that I also run some small venture funds, AVP, Accelerator Venture Partners. We put $1 million+ fund together every year with the intent of writing 10 $100,000 checks and deals. And we invest directly, but we take limited partners like Andy into the fund. If you're willing to invest a minimum of $50,000 to be a member of a fund with a 4% expense category, you can come into the fund and you know you're going to be in 10 of the best deals Keiretsu sees in a year, because the fund is even more rigorous because the LPs are actively participating in helping select the deals. It's not Howard as the GP just pulling them. We do them as a team and we do them together. So there's another way to build your portfolio fairly quickly by getting into funds that we sponsor and we manage. So between SPVs and funds, you can be a very active angel investor. The typical member in Keiretsu is probably involved in 2 due diligence projects a year, which is, again, an average of 20 hours, 25 hours. So 40 hours over a 2,000-hour work year is probably not a lot of time. There we go. Mark.
Wonderful presentation, Howard. Thank you. Very informative. What comes to my mind is, tell me a little bit, if you can, about a typical, young, energetic, brilliant person that started a business that makes your final list, but that you realize is a little raw, does not have maybe the business experience or the polish that might be needed to run the successful business. You had mentioned about betting on the jockey. Is this someone that you would somehow work with to get them to the right spot, or would you say, hey, you know what, they're not the right jockey for us? How do you work through that process?
Wow, Mark, I almost should be paying you to ask that question because it leads into a number of things that are really critical. Number one, the significant, I don't want to say the most significant, but next to the most significant piece of due diligence is the HR portion of the due diligence report, where we typically have professional psychologists who are leadership coaches and specialty experts in the space do the HR section and do an assessment on the entire management team. And when we find a management team that is lacking in some ways, by the way, allow me to point out that we do a lot of investing in deals where the technology has been spun out of a university. And it's been spun out through a commercialization program. And the founder of that company is probably the inventor, professor who invented the cure for cancer at Penn Hospital, for example, who thinks that he's God's gift to the world and is going to build this company because he invented the cure for cancer. And the truth is, none of us will invest in him. We need to help him find a CEO who's been there, done that, and we bring them in. What we are about to announce in November, and this, I would ask that you probably not share this far and wide because the formal announcement has been made yet. But I've been working with a team of people for 10 years now, and they are about to announce a formal Keiretsu branded program where leaders of our portfolio companies will be able to step into a year-long leadership development program, perhaps similar to what a lot of the stuff you're doing here or what they do at Vistage, but focused exclusively on leaders of startup companies, whether they are the faculty member who invented the cure for cancer, who becomes under us the chief scientific officer and never the CEO or president, or the young, brilliant young man who's been able to put, or woman who's been able to put a team together, but needs a lot of help to get there. And that is probably the most significant piece of the puzzle that we bring to the table kind of informally, because we are going to put typically we're going to have parity on the board. We're going to have advisors. Some of those people are going to be there to mentor and coach the management team, or certainly the CEO. And we are now about to announce the first ever formal leadership mentoring and training program for portfolio executives. It does not exist anywhere on the planet. We had the insight to think about it. We've just presented it to Keiretsu leaders in North America. The response has been very strong, and it will formally be announced in November. In fact, on November 16th at our expo.
Yeah, Howard, just to follow up to that, is that a group that is going to be a for-profit group, or is that a group that is just like part of the Keiretsu, offering, if you will, to?
No, actually, it will be a separate business entity that is a for-profit entity that will be run by two psychologists with over 50 years of combined experience and expertise, mostly in the corporate leadership development space. But the last 10 years have been doing this for Keiretsu. They do all of the coaching of every single company that gets invited into forums or our expo. They spend time with each and every one of them, working with them. In some cases, they then invest alongside us and stay available for mentoring as possible. But as a for-profit business, at pricing that, based on the research that's been done, at pricing that's in line or less than typical other groups. But again, the uniqueness of being specifically and only for portfolio company management teams and leaders should end up. If you were a member of our Keiretsu group, when you hear about this, the one thing I hope you would think of is, son of a gun, they figured out how to protect my investment even better. And that's really the back end of this. So it's going to help us attract more members, and it's going to help us protect that return on investment.
So look, I put the link in the chat for Howard's materials. I know from experience there's some really great stuff in that. So I would encourage all of you to look at that and download that information. It's definitely very informative. Really want to thank you, Howard, for your time today. Very informative. As Howard mentioned, anyone who's interested in attending a meeting and finding out more about Keiretsu, just contact me, and I'll make sure you get an invitation to the next meeting you're able to attend. But it's very worthwhile just seeing the process and how it works and experiencing a meeting.
Beacon is the premier executive networking organization serving the Mid-Atlantic region. To learn more, go to beaconforlife.org.